please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, let's come to the topic that most interests all of us. How much do we pay our mutual fund managers? If you remember, Sebi ordered that mutual fund houses should cap their scheme expenses, what you call TER, total expense ratio, and provide benefit of economies of scale to the investors, pass it on to investors. Joining in to assess the impact of this new Sebi rule on AMC companies are Feroz Aziz, Deputy CEO of Anand Rathi Financial Services, and Santosh Singh, Head of Research, India at Haitong Securities. My colleague Reema Tendulkar is also joining us in this discussion. Well, first to you, Santosh, do AMC companies now become a bit of a no-no?
At the current valuations, I don't think Reliance becomes a no-no because it's fallen so much. So it's almost like at a 3% of AUM. So we have a buy on Reliance, but yes, this is fundamentally changing the EPS expectations, because our expectations were of almost 18-20% growth. We might see a decline in EPS in FY20. So that's where it's changing that aspect. And the other aspect which concerns me is the overall inflows in the system, because now you have competing product in AIFs where the HNIs, so the mutual funds would want to sell AIF or set up their own AIFs, or the PMSs. And then you have got the ULEPs where there is the distributors can be paid more against what mutual funds can be paid. So yeah, so that's a concern on the net inflows rather than just the combined the overall profitability of the companies.
Okay, so EPS will be negative and you worry about flows into the equity markets. You spoke about how Reliance Nippon AMC is attractive. You have a buy given the fall. The key concern for HDFC AMC was its valuations. Now it's fallen about 10%, in one swell swoop because of this. Is it now looking attractive from a valuation point of view?
Because the EPS has also fall by 12-13%. So and the other part is that compared to Reliance, HDFC will be more impacted because they have got more equity and they have got larger schemes. So the impact on HDFC AMC will be higher than what it is on Reliance AMC. But if you look at the fall of the stocks, actually Reliance fell 13%, HDFC fell 8%. I was thinking it should have been the opposite way around.
Okay, let me get Feroz into this discussion. Feroz, the trail rule. Until now, the DSA, the selling agent, was paid an upfront. Now they will trail it and see whether the investor stays with the fund. Will this put off DSAs and affect the sales of mutual funds?
See, I think, of course, this is basically done to make sure that the loopholes which the asset management companies were using to garner more money should be put to rest. So I personally think the banking segment, which is a large portion of sourcing, will definitely get impacted. They will start focusing on ULIPs and other products. But having said which, I think this circular is very good for the two listed companies because it creates an entry barrier. And these two AMCs have the potential to transmit 80% of this impact or 90% of this impact to the distributor fraternity. So I would be worried about the distributors rather than the asset management companies because last time when this happened, the entry load reduction, there was a huge 7.5 lakh to 25 lakh AUM growth, which I would see this as a positive consolidation because last 10 years, 10 foreign players have exited this business. And I think further consolidation will benefit the top 6-7 asset management companies, and out of which 2 of them are listed.
Okay. So your point is that they will be able to pass on the hurt, companies like HDFC and Reliance AMC, that the expense ratio that's cut on them, they will cut for the guys who are selling their funds?
Yeah. See, we being one of the large distributors, we clearly know that there is going to be transmission of this straight to the distributor to the extent of 90%. If you take history as some indication of what the actions would be, the last time when there was a 15 paisa reduction on the TER on the basis of exit load component, that was passed on by these asset management companies to the extent of 12 paisa. That is 80% of that was transmitted. So I would clearly think this as a very, very good move from cleansing perspective for the next leg of growth, and for the larger AMCs in the long run. Definitely definitely there could be 1-2 quarters of some slip-ups, but long run it is a very big benefit to the larger AMCs. And the smaller AMCs in the last round of cut couldn't pass on more than 20% to the distributors, and they had to take a P&L hit.
So Santosh, is this positive for insurance companies? Would you recommend a buy on them? Because now clearly it's not attractive for the distributors to sell mutual funds, and they might push for other products like ULIPs.
I don't believe that regulatory arbitrages stay for very long. So, means if last time when all this happened, actually mutual insurance industry, there was a turf war between Sebi and IRDA for long, and we saw what happened to the ULIP products. So I don't think if the insurance regulator doesn't sort of react to it, or maybe then we might see eventually that there might be a turf war, or there might be a war between the two regulators itself, because the arbitrages don't remain. And the other part of the equation is that I don't buy insurance companies because they sell ULIPs. I buy insurance companies because they have the ability to sell other products which are higher margin. ULIP margin is very small. So our stance on life insurance is because of a totally different reason than them selling ULIPs.
Okay, what do you think, Feroz? First of all, will new DSAs not come in because you know that cream is not there up front? And secondly, will they actually resort to selling other schemes? Will they resort to pushing PMS and AIFs?
Yes, PMSs, of course, after the last cut, which was a large cut, where upfronts were brought to 1% and there was a cap. AUMs have almost 10 times. So there is going to be a short-term strategy of the banking specific distribution community to move away from mutual funds. But I think when you're spending 10-12,000 crores in the next 10 years on investor education, which is what is the estimate if Sebi doesn't change the rule, and today you have only 7.5 crore folios with almost 1.5% of the population invested, and emerged markets having 60-70% of Indian population investing, that their population investing, and you're at 1.5% with 10-12,000 crores of expenditure on investor education, coupled with a large incentive for retail participation, be it the SIP upfront or the B15 retail, B30 now as it's called, with education with incentive in the tier 2 and tier 3 cities will definitely motivate IFA, independent financial advisor. I think penetration will go up substantially, and I would not be surprised in the next 10 years if you get to 10% penetration, and that's a lot of money from the lower strata of the community which is going to participate.
Okay. There's one quick number. Is there any amount in terms of how much banks make while selling mutual funds? How big a hit is it in terms of fee income?
So if you believe that banks will take all the hit and all wins, I don't think it's more. It's for the larger one, it's not even a 1% of their total price. Okay. So it's not going to change anything for them.
Okay.
Yeah.
Okay.
Bit for the markets from the morning high. So the Nifty's lost close to about 30 points, 35 points from the top of the day. The bigger nick has come through in the mid-cap index, which is off about 150 points from the top of the day, just about holding on to the green line. And it's the infrastructure names, so a Shrey Infra, a Reliance Infra, HCC, IDFC. So infrastructure as well as, you know, a couple of these financiers of that, which are getting hit in the last 30 minutes. Let's get in a few commodity trades. Let's find out what the early rates are with Manisha Gupta. Manisha?
Thank you so much for that. Well, we have seen the weakness in US dollar as the major reason that you have seen firm opening in the commodity markets. So almost everything in the non-agro space is opening in the green right now. Starting with the crude oil prices, while there was of course some pressure as the US did swipe yet again at OPEC, saying that they should be able to maintain enough supplies, ensure that the prices do not rise up. And there also is an OPEC and the allies meeting on Sunday in Algeria, where they would be discussing on how to fill in the gap because of Iran's sanctions, which countries will contribute and how much. That discussion would be underway on Sunday. So ahead of that, we are looking at steady moves continuing in case of the crude oil prices. As I was telling you, $70 for the US and $78 for the Brent crude is holding in the international markets, and we are looking at steady moves continuing in case of the Indian markets as well. The weakness in US dollar has been supportive for the precious metal space as well. So gold and silver both continue to gain up. This actually is going to be a second straight week which is headed in positive for both of these precious metals. As you can see, 0.5% to nearly a percentage point of gains in both of these commodities. Also, the physical buying has picked up in India, China. There are some reports of central bank buying from Turkey, Russia, etc. And the international markets are taking support from that as well. Well, the oversold situation in the base metal prices seems to be turning around now, especially with the weakness in US dollar, stronger Chinese data, the last couple of them, especially the housing prices, the infrastructure, all of that has come in on the positive, and that has been supportive. Even as we have seen the US-China continue to trade war, the markets do anticipate that it's not going to impact too much in sense of the on-ground metal demand. So that is yet another reason that you have seen the bargain buying return in case of the metal prices. So while the copper prices are trading at a 3-week highs, you have zinc trading at a 2-week highs, nickel prices also trading at a 1-week highs. So almost all of those metals are also headed for a positive closing for this week. Trading strategies, and we have them from Angel, a couple of buy calls from them as well. Buy in gold with targets of 30,750 on the higher side. They have a buy call in the metal space as well. They're watching out for copper at 442 on the higher side for today.
Okay, thank you very much for those details, Manisha. I'm sure the commodities market is going to call the trend, and people are going to watch the crude price very, very closely. At the moment, the dollar also will be watched, and that also is mellow, as you pointed out earlier, and all that is helping the currency and equity markets. But the equity markets are seeing a bit of profit taking. As Rima pointed out, the mid-cap index has lost about 0.5% at an index level, and the Nifty Bank has lost about 0.4%. That is 40 basis points at an index level. So look at the decline and the profit taking we are seeing. Though Nifty and Sensex are still holding on, it looks like there are going to be trades on the long and the short side. All that is coming up for you on Chartbusters, which of course will be led by Rima and Nigel. Let's leave you with a quick snapshot of the important voices on Bazaar today.
We're quite optimistic of the long-term growth of India.
We're very positive on mid-market segment, but looks like that segment is in a kind of a consolidation, and it will continue to be in consolidation despite many bottoms-up stories delivering.
It has been a sustained volume growth across categories.
We continue to be bullish on jewelry growth.
We are also importing quite a lot of raw material,